So perhaps what kind of insights would you give us in terms of structuring the portfolio deliberately from day one, especially when you know that you want to be walking the property investment journey for a few years to come, instead of just having one or two investment properties?
To start with everything in terms, before we even get to structuring the property, you need to define clarity, right? So what's your clarity? What because if you know what you want, you'll be able to filter out the weeds and stay with the best. So that's what you need to do. So if I take it from my personal journey, I would say when I buy a property, any single property, the cash flow must make sense, right? I have to generate at least 5 income streams from a single property. And by that, I mean, the first is obviously, as an investor, is your rental income. The second one will be your capital appreciation, whether you're buying to flip. So then you have to look at your capital appreciation, how to profit by leveraging to invest. How do you protect our money against inflation? And the last, which is the most important one to me dearly, it's very dear to my heart, is how do you generate profitable legacy for generation, right? And those are the 5 basic income I look at before I even touch the property. Once you've done that, then we get to the numbers, because that's what you need to take to the bank. Majority of the first-time investors, 99% make this common mistake. They look at the yield, the gross yield and the net yield. The gross yield and the net yield basically doesn't give you much, because your gross yield is your annual rental income divided by your purchase price. That it doesn't take into consideration the financial costing of your deal. So that is a very wrong number. That is what the estate agents tell you. And for example, you walk on the street, and depending on how much you bought the property, you'll have 5%, 5%, 6%, 7% on the same street. The most important ratio that you have to look at is what is called the cash on cash returns, which people call it your return on investment, your ROI. That takes into consideration, it says your net profit over your cash invested. In simple terms, it's saying how much money can I leverage on the cash that I've invested? That's simple in simplicity. So what do? When you look at your ROI, it just takes your creative mind to start working. Unlike
looking at the gross yield or your net yield,
where you only get the rental. So it's a single family home where you're getting one rental from one family, and that's it. And you divide by your purchase price. But if you do your return on investment numbers, you look at the component. If you break it down and you look at the first component, which is your annual rental, the reason why I said it gets your creative mind to work is then now you don't really consider the price of the property, but you look at the land and the location and what you can do out of it. And if you look at that, just by the rental income, you can split the property, you can remodel the property, you can change the property from commercial to residential and vice versa. So there's so much income, about 80% control on generating massive income out of the property. You then look at your costs, your annual cost, and that you can also manipulate that by either putting heavy deposit in. When you put heavy deposit, it means that on your monthly mortgage is less, so you get a higher number on top, and vice versa, depending on the strategy that you're using.
I think one of the big things that I'm already picking up, and I did say this the last time that we spoke to, is we're definitely going to be inviting you again, because finance, I think I was saying to one of the guests earlier that when you realize that property is finance, you begin to look at it from a fundamentally different lens, that it isn't just about the bricks and mortar that you're looking at, but you need to have a fundamental understanding.